Artificial intelligence crashes global stock markets. The explosive growth anticipated from the so-called artificial general intelligence, AGI, is seen as the holy grail of all technological advancements related to AI. However, predicting the timeline for achieving this stage from the current level of AI development is impossible. One of the key reasons for the severe crash in global stock markets on August 5 was the decline in shares of the largest technology companies. Asian markets were particularly affected, with notable drops in Japan, South Korea, and Taiwan. For example, South Korea's Kospi index fell by 8.8%, setting a new record low since the fall of the 2008 financial crisis. Although the stock markets showed a rebound on August 6, investors still anticipate further waves of decline. The next wave might be significantly influenced by the American Nasdaq exchange, where shares of major tech companies such as Intel, Microsoft, Nvidia, Meta, recognized as an extremist organization in Russia, Google, and Amazon are traded. Currently, after weak reports, investors are selling off shares of these companies, facing a harsh reality: massive investments by big tech in AI technologies have not resulted in growing profits. It remains uncertain when they will. This uncertainty is compounded by the expectation of an economic recession in the United States. Investing in trendy technologies is easy in a stable and growing market, but with an abundance of black swans from the South China Sea, the Middle East, and even the Baltic, investors' appetite for risk has significantly diminished. Considering that big tech was the main driver of growth for the American and major regional stock markets, the current crash is quite predictable. The parallels between the current explosive investor demand for AI and the dot-com boom of the 2000s are not accidental. Both then and now, there is a discrepancy between expectations and reality. It is clear that sooner or later, new technology will provide a real increase in labor productivity. The problem is that the difference between sooner and later has a specific monetary value. Investors, seeing a promising technology, fear missing out on a train that will take them to astronomical profits. However, the companies that are supposed to generate these profits are currently only generating losses from the large capital investments required to develop new technology. For example, the capital expenditures of just 4 companies, Amazon, Alphabet, Meta, and Microsoft, have exceeded $106 billion since the beginning of 2024. The lion's share of this money went towards purchasing land and constructing data centers for the computational power required by AI. This creates an interesting paradox: AI technologies are not yet generating significant profits, but the fear of falling behind competitors forces major companies to invest more and more money in technology with dubious profitability, reducing company profits and dividend payouts. Investments in AI still appear to be venture capital. Currently, generative AI is mainly in demand in the creative industry, visual content, journalism, education, etc., jurisprudence, and the B2C segment, various voice assistants, chatbots, etc. However, modern AI technologies do not allow businesses to increase productivity exponentially. More pleasant and convenient chatbot interfaces, cost-cutting in law firms, editorial offices, and educational platforms save 10 to 15%, in some cases, 20%, of costs. This is a substantial aid to business, but it does not represent the explosive growth in efficiency that would match the mass expectations of AI. A significant economic effect from using AI could theoretically be achieved in the industrial sector. However, automation processes in manufacturing have already advanced significantly, and the addition of AI will not provide a substantial increase, at least not yet. Technologies are developing rapidly. The explosive growth can be provided by the so-called artificial general intelligence, which is considered the holy grail of all AI-related technological solutions. However, predicting how quickly the path from the current stage of AI development to the desired one will be traversed is impossible, just as it was impossible to predict when and if the Higgs boson would be found. Peter Higgs, who predicted the existence of this particle back in the 1960s, could not have imagined that experimental proof of his theory would only be obtained in 2012 with the help of the Large Hadron Collider. It is unlikely that investors in companies betting on AI are willing to wait that long. They are not ready to wait for decades or even a few years. For instance, interest in Apple shares fell after Bloomberg reported that the company might postpone the release of its first self-driving car until 2028. Moreover, the degree of autonomy of such cars is likely to be revised. Shareholders of tech giants had already imagined roads filled with self-driving vehicles, level 4 autonomy, which does not require human involvement. But reality has tempered expectations. Now it's only about level 2 autonomy like Tesla, partial automation of processes where the driver still needs to monitor the road situation. This is why in Russia, promising but not immediately profitable technology is developed with the support of the state and the quasi-state sector. For example, the National Strategy for the Development of AI until 2030 assigns a significant role to the state, especially in terms of infrastructure development and personnel training. In this sense, state participation significantly reduces the effect of disappointed investors on the stock market. Competition in this segment will take a more pragmatic and result-oriented approach.